Hello, we've been talking about property, plant, and equipment. That's also known as tangible property because you can touch it, see it, use it. And now we're going to turn our sights on intangible assets. And intangible assets we can't touch, but they have value. So thus we need to track them on the balance sheet and the income statement. So let's take a look. Intangible assets. They are characterized because you can't touch them, see them, or do anything about them. They're sometimes highly uncertain about future benefits because you're not sure whether they are going to be beneficial in the future or not. But if they have a definite life and usefulness, then you will amortize them over their useful life. And the adjusting entry to amortize an intangible is to debit amortization expense and credit the intangible asset. Thus, over the life of the intangible asset gets smaller and smaller until poof, it's no longer on your balance sheet because you have used or consumed its benefits over its useful life. There is an exception with goodwill, and goodwill arises when one company buys another company and pays more for that company than the value of its underlying assets. So the difference is goodwill, or the value in the company that you can't touch with tangible assets. And that goodwill, because it has an indefinite life, is viewed each year with a computation about impairment, and that impairment computation is beyond the scope of this class, but we revisit it and reevaluate goodwill on an annual basis to figure out whether we need to write it up or write it down over time. So let's take a look at specific intangible assets you may know and love. Oh, and under IFRS, you can revalue your intangibles, but it's not a requirement. So be aware that there's different treatment under IFRS rather than US GAAP. So patents are something you might know about. Since it has a definite life, 20-year legal life, you will amortize patents. And these are patents that generally you acquire externally, because if you develop a patent internally, that's called research and development, and you expense those in the year that you're spending the R&D costs. So these are patents that generally you acquire from the outside, or the legal fees for successfully defending a patent, and thus you will amortize them by debiting amortization expense, crediting patent over the 20-year life style. R&D. These are for internally developed patents. This is research and development costs, and currently we expense them in the year that we incur the expenses. So we no longer capitalize them and put them on the balance sheet. We expense them as incurred, which is what it says down here. Copyrights. Copyrights, again, have a useful life of 70 years, so you will amortize a copyright. Trademarks and trade names, because they have a useful life, you will amortize trademarks and trade names. When I'm dealing with organizational costs, though, those are expensed in the year that they are incurred. So as you're getting your company up and running before you accept your first sale, those are called organizational costs of getting your company legal, to get your corporate charter, to get your accounting records set up. All of those things are expensed when they're incurred. Other intangibles you can have are the goodwill, and goodwill, remember, we evaluate and reevaluate each year with the impairment test, which is reasonably complicated, and you just need to know there's an impairment test done annually. So when we look at a problem where we could apply it, here one company, D, purchases another company, S, for $1.8 million cash. The total fair market value of the underlying assets in S are $1.35 million, and the liabilities are valued at their fair market value. And here's S's balance sheet at the time of purchase. So what do you do when company D acquires company S? On company D's books, you're going to be debiting the assets for their fair market value, $1,350,000. You're going to credit the liabilities, which are the liabilities you're assuming, which are $250,000. You're also going to be crediting cash because remember you paid $1.8 million for this company, and because this doesn't balance, the difference is debited to goodwill, and that's the intangible goodwill that we will reevaluate every year. In Part D, in recent past, goodwill was amortized over a period of time not to exceed 40 years. Why not? We use impairment instead because goodwill and one company buying another company looks good on paper when you begin, but over time may not be what they thought it was going to be. And so they use impairment rather than just writing it off over a fixed period of time. So that's an example of how do you buy one company and recognize the goodwill, which is the difference between the assets and liabilities you acquire versus what you paid for them. So when we look at IFRS versus US GAAP, notice under US GAAP we always keep our long-lived assets at their original cost, less accumulated depreciation, in other words, their book value or their carrying value. But notice under IFRS, companies can either follow US GAAP or they can periodically revalue their long-lived assets up to their fair market value. So in essence, the US GAAP follows the lower of cost or market. It's more conservative. Whereas IFRS says, sometimes property, plant, and equipment, the market value is something that's more important to know about and to track. And so they use what's called a pure market valuation principle.